Back with us here on Trading Hour. The Nifty is now at the highest point of the day. 22,172 is the day's high that it made, and it is now trading slightly above the 20-day moving average, which is 22,162. So good going there for the index, and Reliance Industries continues to pull the index higher. It's now up almost 3% as we speak. The lead contributor to the Nifty upside, 2966 on Reliance Industries. So good going there for the index heavyweight as well. Let's now invite Madanagopal Ramu, the fund manager and head of equity at Sundaram Alternate Assets, to discuss market fundamentals, his top sectoral bets and much more. Madanagopal, good morning. Thank you so much for joining in. I'd like to start off by asking you about the real estate space, and it's been a pretty mixed bag for real estate. The stocks have moved from strength to strength over the last 12 months, but there has been a bit of a correction. Now there is a rebound as well. Do you find valuation comfort in this space, considering how stocks like Prestige, Soba, DLF have run up in the recent times?
We don't own much of real estate primarily because it's getting very difficult to judge the cycle from a short-term perspective. The stocks have rallied a lot. The demand that has come back in 2023, we are not very sure whether it will continue in 2024. We are seeing already job cuts in IT sector. So we need to be a little more cautious on how the real estate sector demand will continue to do. So at present, we don't own much of real estate stocks in our portfolios.
Any new additions that you've done? You manage 4 portfolios, which includes, a multi-cap fund, you have emerging stars fund, you have a small cap fund. In the last 1 month, can you share some of the recent additions that you've made across which portfolio?
Sure. So we have added some stocks in the auto space. If you look at auto space, the thing that is really working on is the premiumization. Every new launch, every new car launch or a two-wheeler launch, you are seeing better digital clusters coming in, or connectivity with the vehicle is improving. With that, what is happening? We are seeing content per vehicle is increasing for some of the auto and companies. While the overall volume growth of auto sector might be in high single digit, but you will benefit if you get into some of these auto angs, which are growing double the volume growth of the auto space itself. So we have added some stocks like Unominda, Motherson Sumi, and Precol in our portfolios. All these 3 companies are beneficiaries of the content per vehicle story and the premiumization story that is happening in the auto space. So that's a new area where we have made some allocation. On top of it, I think we continue to be very bullish on the NBFC space as against banks as such for the next 2-3 years growth perspective. On the consumption space, we are always positive on the consumer discretionary compared to FMCG, which we continue to bet on and keep adding stocks wherever we find comfort. On manufacturing side, we are very comfortable on the power sector side, where we have stocks like BHL. So this is how broadly the portfolio is positioned.
Interesting. I was reading a note, Madanagopal, and you have also initiated positions in Zomato. And the stock over the last 12 months, if you can pull up the 12-month chart, it's up almost 250, 270%. It's more than tripled. Your note also says that valuations have also run up for the stock. But what is driving your bullishness at these valuations? Because you say that it is just reflecting the current earnings of its food business.
Sure. Actually, Zomato, we added in one of the portfolio recently, but Zomato has been there with our primary portfolios for the last 1 year or so. We started adding Zomato when it was 50 rupees sort of a stock price. It has almost gone up some 3 times from those levels. So the point with which we entered Zomato was Zomato will be able to have a bargaining power from the restaurants and able to charge them better. And that's what happened. They almost increased their commission rates by almost additional 20 rupees in the last 2-year time period, which has helped them to improve their profitability in the food delivery business. On top of it, right now, what we feel is their advertisement revenue can go up because restaurants want to have a higher delivery mix in their business. So the good restaurants will go and don't mind to pay a little bit more to food delivery partners like Zomato or Swiggy. So that's something which can continue to play for the next 2 to 3 years also. In addition to it, what we are witnessing right now is these guys are able to monetize from the customer side also. They used to have the food delivery charge, net of discounts, not much they used to make, but today they are making a spread on that also, which is also improving. So advertisement revenue improving, and the charges from the customers. These are certain new things that are happening in this business, which is adding on top of the expectation that we had in the food delivery business. So this is one. On top of it, if you look at the Blinkit, when we invested, we did not factor much of a valuation from Blinkit. But today, Blinkit is turning around much faster than what we expected. If you look at even in Blinkit, they are able to charge or monetize the convenience factor on the customers. So this is what the new developments that are happening in Zomato, which we feel over the next, say 5 years or so, as the penetration level increases for these businesses, as the economies of scale plays out, you will also see these companies able to monetize both from the customers as well as from the restaurants. That will keep their earnings growth on a upward move and keep surprising the market. You cannot take a 1 year view in these stocks. You have to invest and wait for at least 2 to 3 years to make a substantial return. So that's the reason. And we continue to hold in our existing portfolios. We have actually added in one of the other portfolios which you are referring to.
Okay. Home First Finance has been a part across many of your portfolios, and this stock has underperformed in the correction that ensued in the broader market. How would you approach Home First Finance now?
Home First, from the point that we added, has done well for us. It has almost doubled. Yes, as you said, it has underperformed the small cap banking index. One of the reasons is Home First is into affordable housing business, and we had some PE selling happening in the stocks continuously. That is one. We don't mind that because we like to add these stocks when the PE is selling, and when the PE selling is over, you will get a good valuation coming back. Right now, the stock is trading at around 2.5 times price to book value. And if you look at the company has potential to deliver something like 25-30% growth on a sustainable basis. Companies predominantly into Western market and gone into South markets recently. And I think they will establish presence in 15 states and become a pan-India sort of a player. So the growth here is given compared to 10 to 15% growth that you're looking at banking space. Here the growth will be substantially better. Margins took a beating primarily because the rate increase cycle. And now that is behind you. So next 2 years, if you expect the rate cycle to normalize or even come down, you should bet on names like this because their margins will expand now, as against banks where the margins can go through a correction as the cost of funds picks up increases in the next, say, 1 year or so. And later on, when the rate cut happens, also banks will go through initially a margin compression story. So during those periods, NBFCs like Home First, which have a very high sort of a margin, which has gone through some compression in the last 1 year, can start improving. You will see earnings upgrade happening in these names. And currently, the valuations are very compelling. You are getting a high growth name like Home First at around 2.5 times price to book value. They have traded in the past names which are growing like this around 4 times price to book value also. Even if they were to go back to 3.5 times price to book value, in addition to the earnings growth, you will see a good amount of money to be made in names like this.
Interesting. Thanks a lot, Madanagopal, for sparing time and joining us this morning and sharing your views on the markets and on stocks like Zomato as well as Home First Finance. Time for a short break here on Trading Hour. When we return, we'll get you excerpts from our exclusive conversation with market veteran Ramdev Agrawal of Motilal Oswal Financial Services. Stay tuned. We'll be right back.